Exchange-traded funds, or ETFs, were once described as the new kids on the investment block. But today, they're giving traditional mutual funds a run for their money. Both ETFs and mutual funds are viable choices for investors, but with so many investment choices available on the market, it's important for investors to familiarize themselves with the basic benefits of ETFs. An exchange-traded fund, or ETF, is an investment product representing a basket of securities that track an index such as the S&P 500 or the Russell 3000. ETFs were first introduced on the Toronto Exchange in the 1990s and debuted on the American markets in 1993. Most importantly, ETFs offer some distinct advantages when compared to individual stocks and mutual funds. Trading like a stock. The easiest way to highlight the advantage of an ETF trading like a stock is to compare it to the trading of a mutual fund. Mutual funds are priced once per day at the close of business. Everyone purchasing the fund that day gets the same price, regardless of the time of day their purchase was made. In contrast, you can purchase and sell ETFs at any point throughout the trading day and will receive the market price at the time when the order is placed, like a stock. Low-cost expense ratios. As passive investments, ETFs generally have lower operating expenses and lower management fees, resulting in lower annual expense ratios than many other investment products. Diversification. ETFs come in handy when investors want to create a diversified portfolio. There are hundreds of ETFs available and they cover every major index, S&P, Russell, and sectors of the market such as large caps, small caps, growth, and value. For example, there are international, regional, country-specific, specialized industry, and market niche ETFs. Tax efficiency. ETFs are generally more tax efficient than index mutual funds. Index funds themselves are highly tax efficient compared to actively managed mutual funds, but they still produce a capital gains distribution, which means that investors who hold them in taxable accounts will get hit with the tax bills. In contrast, index ETFs generally produce minimal or no capital gains distributions. The broader and more liquid the index, the smaller the capital gains. Transparency. Actively managed mutual funds report their holdings on a quarterly or semi-annual basis, whereas ETFs disclose their portfolio holdings on a daily basis. Investment decisions can be confusing. If you'd like to learn more about incorporating specific ETFs into your investment portfolio, please call our office and schedule a complimentary consultation. We look forward to your visit.